Index funds are the safest way to build wealth. You buy the whole market. You ignore the noise, and you retire in peace. That is the story. Here is the wiring. Chapter 1. How does a safe fund become a mandatory buyer? In December 2020, S&P Dow Jones Indices announced that Tesla would join the S&P 500. The stock had already risen more than 700% that year. Passive funds tracking the index had to buy roughly $70 billion of Tesla stock in a single day. They were not allowed to negotiate the price. They were not allowed to wait for a dip. The mandate required them to buy at the peak. S&P Dow Jones Indices is the division of S&P Global that maintains the S&P 500. The list of the 500 largest publicly traded companies in the United States that serves as the benchmark for trillions of dollars in passive investment. When they add a company, every fund that promises to mirror the index must buy that company in exact proportion to its size. Vanguard is the world's largest provider of mutual funds, managing over $8 trillion primarily through passive, index-tracking strategies that automatically mirror the S&P 500 and other benchmarks. When Tesla entered the index, Vanguard's funds had no choice. Their entire value proposition is that they do not pick stocks. They follow the list. Here is the mechanism they do not put in the brochure. If the list says Tesla is 3% of the entire market, Vanguard must allocate 3 cents of every dollar to Tesla, regardless of whether the price makes sense. If the list says a future artificial intelligence company is 5% of the market on its first day, the same rule applies. Every month, roughly 100 million Americans contribute to retirement plans that track this index. Their contributions are automatic. Their withdrawals are automatic. And when the index committee adds a new member, their buying is automatic. They do not get a vote on whether Tesla is too expensive. The mandate votes for them. And here is the part that took me longer to understand. The index committee is not trying to hurt anyone. They are doing their job. The S&P 500 is supposed to represent the market. If a company is huge, it must be included. But that mechanical fairness creates a mechanical trap. The bigger the bubble, the more the index must own it. The label says diversification. The wiring says concentration. When a hyper-valued company enters the index, these funds do not spread your risk. They concentrate your retirement savings into a single stock at its absolute peak. The index mandate does not negotiate. It buys. I used to view passive index investing as a neutral, mathematical baseline for building wealth. But seeing a single stock entry force tens of billions in automatic buying shifted my perspective from safety net to rigged transfer. The fund that promises to own everything is not allowed to skip the one thing that matters most. Tesla was only the preview. The next entries will be larger, and your fund will have even less choice. But how do companies reach such staggering valuations before the public market even gets a look? Chapter 2. How do private prices become public commands? In late 2023, a partner at Thrive Capital signed a tender offer document to purchase existing shares from OpenAI employees. The valuation on that document was roughly $80 billion. It is easy to assume the price reflected a rigorous projection of future software sales. It did not. Thrive Capital is a venture capital firm led by Josh Kushner that has led multiple late-stage funding rounds for technology companies, including OpenAI and Stripe, often purchasing shares directly from insiders rather than investing new capital into the business. OpenAI is the artificial intelligence research and deployment company behind ChatGPT, which has seen its private valuation climb from roughly $20 billion to over $100 billion in just a few years. Here is the mechanism they do not put in the brochure. In a secondary tender offer, the company itself receives $0. The money goes directly into the pockets of early employees and founders who are selling their personal shares. The company does not build a new factory. It does not hire new researchers. It simply gets a new higher sticker price. That higher sticker price becomes the baseline for the next round. If Thrive Capital pays $80 billion, the next investor cannot pay less without triggering questions. So the next round becomes $100 billion, then $150. The company never has to prove it can generate matching revenue. It only has to prove that someone with billions in idle capital is willing to pay. When giant asset managers want exposure to artificial intelligence, there are only a handful of late-stage companies willing to sell. The scarcity of sellers meets the abundance of capital, and the price detaches from business reality. When I first mapped the gap between these private tender prices and OpenAI's actual revenue, I felt a distinct sense of alarm. The numbers were not reflecting business reality. They were reflecting a closed-loop financing game designed to enrich early insiders. Thrive Capital's tender offer did not fund OpenAI's research. It funded employee exits. The company received no new money, only the sellers got rich. And here is the part that took me longer to understand. The public market is not the exit, it is the validation. The initial public offering does not raise money for the company. It raises money for the insiders who need to convert their paper wealth into cash. If you contribute to a target date fund, your dollars are joining the chain at the exact moment when the early sellers are cashing out. A price set in a closed room does not automatically survive the open market. But by the time it reaches your fund, the index committee has already decided the market is whatever the last tender offer said it was. But even if these companies do go public, the rules of the game have changed for the everyday buyer. Chapter 3. Who owns the company you are forced to buy? In May 2012, Meta Platforms filed its initial public offering paperwork. Hidden in the prospectus was a single line that should have stopped every retail investor cold. The founder would retain roughly 60% of the voting power while owning less than a third of the economic interest. Meta Platforms is the social media giant formerly known as Facebook, which operates Facebook, Instagram, and WhatsApp, and went public in 2012 under a dual-class share structure that grants insiders 10 votes for every public share. Alphabet is the parent company of Google, which executed a complex stock split in 2014, creating Class C shares with zero voting rights, permanently cementing founder dominance over the board of directors. Here is the mechanism they do not put in the brochure. A dual-class share structure grants founders 10 or more votes for every share they hold, while public investors receive 1 vote per share, or sometimes none at all. You are not buying a piece of a company to guide its direction. You are buying a non-voting economic ticket that funds a founder's unchecked vision. The traditional promise of the public stock market is that capital comes with corporate accountability and a say in governance. That promise has been rewritten. The second largest stock exchange in the world has gradually adjusted its listing standards to accommodate companies with unequal voting rights. The exchange does not require founders to share control, it requires them to list. And here is the part that took me longer to understand. The aerospace manufacturer, widely expected to pursue a public listing, maintains a governance structure where the founder retains absolute voting control, entirely insulated from outside capital influence. When your retirement fund is eventually forced to buy that stock, it will be buying into a company where the founder cannot be fired by the shareholders who own it. Realizing that the ownership marketed to retail investors is functionally an interest-bearing loan with zero governance rights made the entire premise of public market participation feel deeply cynical to me. You are not buying a seat at the table, you are buying the chair they no longer need. Meta's prospectus warned investors. Alphabet's split eliminated them. Your fund bought anyway. The voting power never leaves the boardroom. It simply charges rent on your retirement savings. So, if the buying is mandatory and the control is fake, what happens when the price finally breaks? Chapter 4. What happens when the machine starts selling? A quarterly rebalancing report lands on a portfolio manager's desk at State Street Global Advisors. It mandates the immediate sale of millions of shares to adjust for a dropping market capitalization. The manager does not get to ask whether the company is still good. The formula has already decided. State Street Global Advisors is one of the largest asset management companies in the world, known for creating the first exchange-traded fund and managing massive passive index portfolios that track the S&P 500. The Financial Industry Regulatory Authority, or FINRA, is the self-regulatory organization in the United States that oversees brokerage firms and monitors systemic risk, though it cannot stop mechanical index selling. Here is the mechanism they do not put in the brochure. When a mega-cap stock's price falls by 20%, its weight in the index drops proportionally. To maintain the correct mathematical weighting, index funds must sell shares. This selling pressure drives the price down further, which triggers another rebalancing requirement, forcing more selling. The prevailing narrative is that passive investing stabilizes the market by providing a constant, steady base of buyers. That is the story. Here is the wiring. During a market correction, those same mechanical rules force funds to become aggressive, indiscriminate sellers, regardless of the underlying company's actual health. The very mechanism that inflates the bubble on the way up is the exact mechanism that accelerates the crash on the way down. And here is the part that took me longer to understand. The same funds that were forced to buy at the peak will be forced to sell at the trough. They cannot deviate. They cannot hold cash. They must sell until the weight matches the price, and the price matches the weight, in a spiral that only stops when the market closes. When I traced this automated feedback loop, I shifted from viewing index funds as a boring, stable market default to recognizing them as a highly leveraged, systemic vulnerability waiting for a trigger. The autopilot that climbs the mountain is not programmed to question the cliff. Every automatic contribution that built the bubble on the way up becomes an automatic withdrawal that feeds the fire on the way down. The teacher, the nurse, the factory worker, none of them voted to sell. Their target date fund simply followed the formula. The rebalancing report does not ask for permission, it simply commands. And your retirement account obeys. State Street's algorithms do not call a board meeting to discuss whether the artificial intelligence company is still viable. They simply execute. FINRA watches the systemic risk build, but it cannot override the mandate. The automation that builds wealth in a bull market is the exact automation that accelerates its destruction. If the machine is this broken, what rule would actually stop it? Chapter 5. What rule would break the machine? The checkbox that enrolls you in a target date fund is the same mechanism that prevents you from asking questions. Every payday, the contribution is automatic. The allocation is automatic. And the purchase of the next trillion-dollar bubble will be automatic. The system is not broken. It is functioning exactly as designed. The Securities and Exchange Commission, or SEC, is the federal agency that oversees securities markets and has the authority to set listing standards and disclosure requirements for publicly traded companies. The SEC oversees the markets. The federal agency that oversees retirement plans monitors the menus, but none of them have stopped the mechanical mandate. Here is the mechanism they do not put in the brochure. The rules that govern your retirement account were written for a market where public investors had rights, prices were discovered on an exchange, and companies needed your capital to grow. That market is gone. The new market sells you non-voting shares in companies that do not need your money, at prices set in private rooms through formulas that cannot deviate. So what rule would actually break the machine? One approach is simple. Bar companies with dual-class non-voting shares from entering major indices like the S&P 500. If public investors are required to buy, they should at least be guaranteed a vote. Another approach is to delay index inclusion for 1 year after an initial public offering, forcing the market to discover a price before the mandate kicks in. A third is to cap the weight of any newly added company at 1% of the index until it has reported 4 consecutive quarters of public financials. These are not radical ideas, they are structural guardrails. The index committee already has discretion over which companies qualify. The SEC already has authority over listing standards. The only missing ingredient is the recognition that a retirement account is not speculative capital. It is survival money. And here is the part that took me longer to understand. The solutions being marketed right now run in the opposite direction. The push to include private equity and pre-IPO shares inside 401k plans does not fix the wealth transfer. It expands it. It gives the machine more inventory to buy before the public offering even happens. When I realized the proposed fix was to feed the machine even more capital through private equity, I felt something beyond alarm. I felt the system was not failing to protect workers. It was succeeding at extracting from them. The label says democratization. The wiring says earlier extraction. The central unresolved exposure is this. Roughly 100 million Americans are enrolled in automatic retirement plans that track indices. Those indices are designed to represent the market, not to protect the buyer. When the next artificial intelligence giant enters at $1 trillion valuation, your fund will be required to buy it. Not because anyone thinks it is worth that price, because the formula says it is the market. The story is ongoing. The public offerings have not priced. The index committees have not met. The wealth transfer is still being wired. The checkbox that enrolls you in a target date fund is the same mechanism that will enroll you in the next bubble. The only question is whether anyone will give you the right to uncheck it.